Yes. So, good morning. Shall I start? Right. So, others are not joining. Right. So, basically, so today I plan to discuss on one question with regard to computation of income tax liability of company, as well as another small area that is we didn't do that social security contribution. So, small area. 10 to 15 I will take through that one. And tomorrow also we have another session. So in that session I am going to discuss the computation of elevated tax. Right, in this particular question paper also there is the question. And other areas, basically this type of question will be tested in the examination as well. Right? So straightforward question. So you are giving that profit before tax, and thereafter give the details of income and expenditure which has been considered when they align the profit before tax. Right? You do the adjustment and compute the expectation could be this area. Computation of taxable income, tax liability, and balance tax payable, or the requirement is right? And thereafter, the small part of the same question will be tested about how the application of other taxes is paid. Right? It's some types of tax planning or tax compensation, that type of question, right? And question 2 will be again other person who is joining this don't online in that they can hear me, right? Right. So second question, it will be on the computation of tax liability of the company, right? For the company basically. So this type of information in which one the output tax and input tax related information you do the computation and some administrative provision with regard to submission of tax return and blah blah blah. Right? But here is the and 3 and 4 question will be either non-resident tax computation, not on the that question will not focus on the computation of the tax liability, right? The scenario which is applicable for the non-resident, right? So whether there is a fee, creation of fee, whether they are liable for Srilanka income tax liable, right? And another question, general tax administration. Tax, there is also some sort of compliance requirement. Simple example, just like payment and how is liable for withholding tax, requirement of deduction of withholding tax, and the responsibilities of the withholding agent and likewise. Right? Small question. So that this could be an ideal discussion. There will be more questions. So 5 questions out of that you have to select 4 questions. Question 1, 2 are mandatory, right? Basically, 1, 2, 3 are mandatory, and the 4 and 5 out of that one you can select and that is in the structure of a paper and the area that focus on the examination content. Right? That clear? Any question? So shall we read that question number 1? Right. So in a practical situation, although in very similar way, we need to work out the tax liability. So then the financial statement and related information we have to gather first. Thereafter, we have to initiate the computation, right? So in practically, say if I am doing tax computation, so I am getting the either draft computation or the management accounts. Sorry, draft financial statement or financial statement or management account. Because you know that before we finalize the original financial, so it is required to make the tax provision. Therefore, ideally, it is based on the management accounts or the draft audited financial statement, right? So, as we discussed, we can utilize the profit or the loss worked out by the financial statement purpose, reporting purpose, based on the general acceptable accounting principles. That means any financial statement which has been made based on the SLFRS LKH, we are accepting as it is. We can, because as per the tax law it says, right? That provision is there. So therefore, that it can be considered the base for the computation, right? Thereafter, we can do the adjustment, right? So if I put it in this way, so in the financial statement, comprehensive income statement. So you know that full set of financial statement means comprehensive income statement, financial position, cash flow statement, and changes in equity, and thereafter note to the financial statement. That is the full set of financial statement. So that is required if you are practically when you are doing the tax computation. Reason is that the comprehensive income statement shows us the profit before tax or loss, which work out as per the reporting framework, right? So in the financial questions, you can check the movement of assets and liability. Especially, you know that when we do work out the what is this capital allowances, we need asset purchase, detail of assets, which has been purchased or used for the business generation of profit, right? Production of income. So that notes are in reality that notes are in the comprehensive income statement. Sorry, not the comprehensive income statement is there in the statement of financial position. And also, so in practically when I am doing tax computation, I am especially requesting the cash flow statement as well. Because cash flow statement shows any notional expenditure which has been charged to the income statement, especially provisions, depreciation, gratuity, payment of gratuity, payment of interest, payment of taxes, and borrowings made during the year, and settlement of borrowing, lease interest, lease payment, that are being influenced by there. Quite a lot of information which are very important in tax perspective. Right? So they are in practical, I am a little worried about that. I am taking that because cash flow statement really shows the operating results of the business. Split to operations, investment, and like that, right? So therefore, it is very important. And also changes in equity, you can check if that company has been distributed dividends, revaluation reserve, the structure of the reserve, what the amount coming from the income statement or any other reserves they have built, that is there. So especially when we are work out what the thing capitalization, then finance cost. So that reserve question and the issued share capital are there in the changes and equity. Statement of changes in equity. They are the note for the financial statement. Right? Because financial position shows the assets and the liability as of the date. The note shows any movement. Let's say you can check, especially in case of the disposal of assets, investment, because it could be liable for capital gain tax. Right? In case of the investment property, that those details are there in the notes. Therefore, you have to take the full set of financial statement when you are doing the tax computation in a practical aspect. Right? Remember that. Right? Therefore, I am much worried about the full financial statement when I am working out the tax computation for a company or the person or whatever. In case of especially business. And also, you know that in our case, we recognize basically the 4 source of income, and in company, we are going to get that employment income, but there could be different investment income. Right? So the investment income we can figure out from the financial statement based on the classification of assets. So they can keep enough property. They may have fixed deposit. So those income related to those types of assets definitely goes under, let's say investment income. Right? Let's say the company is running a manufacturing business and they keep money as fixed deposit or invest in treasury bill for a 5 year or like that. That means that excess money they have invested. So income source for our purpose would be investment. Income from investment. Right? So it is not part and parcel of business topic. Right? That's the approach for the computation in practical. End of the day, you should have that knowledge to apply that to work out a computation in a real case scenario. Right? So in this examination context, I am given that relevant details. You to work out the computation, not much. I'm not getting full data financial statement. Relevant notes I'm picking and I'm putting that. Right? That's how it happens. So as approach, you can see in the comprehensive income statement, we can get the profit or loss. Right? Profit or loss. Remember, for the tax purpose, we are using the profit before tax. Reason is that section 10 itself says that income tax expenditure is, or the income tax charge as per the tax law is disallowable. We cannot allow. Therefore, we are using the profit before tax. Before we use the PBT. How the PBT is arrived? So in the comprehensive income statement, there could be two parts, right? Income, expenditure. So from income side, we have to check what is the source of income for tax purpose. Is there income from investment? Is there income from business? Like that, right? That's the source. So and also there may be some items that require special tax treatment. Adjustment for adjusting even for tax, right? So here we can check basically business investment like that, right? Here any adjustment required, any item that require special tax adjustment. I could say in simple way, say as per the detail, is that the item called what is this disposal profit on asset. Disposal profit from disposal of property, plant and equipment. Remember that accounting profits we are not considering. We have to do the adjustment in case of the depreciable asset. That is we call as the charge of the balancing allowance. And we have to figure out that this profit or the loss as per tax law. That we need to figure out. So that is special adjustment that need to be done. Right? And the expenditure side also say right? Category of expenditure we have to check. Some expenditure is allowed for tax purpose, some are not. Right? Allowable and disallowable. So under the allowable expenditure, that should have already been charged when we are arriving the PBT, and tax purpose also that is deducted. And then there won't be any adjustment for that. Some expenditure which has not already been deducted, when we align the profit before tax for the purpose of computation of taxable income from business, we can allow. Simple example is capital losses. That capital losses we have not considered when we have worked out the profit before tax. Therefore, we have to separately work out and we can allow that expenditure. The staff remuneration. It has already been considered when we work out profit before tax, and tax purpose also, if it is incurred in the production of income, we can allow. So therefore, it is allowable expenditure, but there is no requirement making an special adjustment. Right? So disallowable expenditure, that means when we work out the profit before tax, it has already been considered or the deducted, but for the tax purpose, we are not allowed. So then that need to be adjusted. So this is the approach for when we work out the computation using the profit before tax. Right? So you know that if the company is entitled for enhanced capital allowance, there will be that type of expenditure when you work out the profit before tax, because enhanced capital allowance means we are giving the 100% cost as allowance, right? Investment cost as allowance. So therefore, that is especially we have to take under the finance code, in capitalization. So there will be a part of expenditure allowed, part may not be. There's a restriction, and that means there some parts entirely disallowed. There may be allowable part, but there's a limitation. That balancing we can carry forward the next succeeding year. There is no such cost for the tax in the financial statement, but in the for the tax purpose we can claim that tax losses, right? That you have to consider. Adjustment required or adjustment required, right? Right. Based on that, we'll read question. So, Pinchon Private Limited is a resident company. It's a resident company in Sri Lanka and engaged in the business of manufacturing and exports of some sort of product, right? Those products including electrical tubing and protective tubes used to route and protect electrical wiring in building and other structures. The following information was extracted from financial of Pinchon Private Limited for the year ended 31st March 2024. So they have given some sort of, in the first para, they are giving us some sort of introduction of what they are doing. So you have to decide any expenditure of the income which is generated from business or not. That's the whole intention of the first para. Thereafter, second para basically it could be the structure of the business, capital structure, and detail of the profit before tax. Or in the examination context, it could be given the detailed profit and loss account. So net profit before tax. So it's not to worry about before tax. After charging all expenses and crediting the whole income was 45 million something, right? And PBT they have it's a profit. Total turnover of the company was this one. Issued capital asset 31st March 2024. To million and reserve is 15 million. This reserves include revaluation gain from assets of rupees 13 million. Company is reporting currency is USD. And remember, as per the tax law, we cannot work out income tax other than LKR, any other currency. The reporting currency could be other designated currency, just like USD, Euro, GBP, whatever. But for Sri Lanka tax purpose, we have to work out financial state or we have to work out the tax in LKR. It says if any financial statement prepared other than Sri Lanka rupees, we have to convert to LKR using ideally spot rate. Otherwise, there is a guideline. We did that how to treat the exchange rate or the exchange conversion impact, right? So it says just USD, right? But all the figures are given in LKR, so not to worry. But if they have examiner can test this type of thing. So if they are telling that there is a transaction happening outside Sri Lanka, definitely there will be exchange impact, import or the export, both. There would be impact, right? Other than the entity, the company is doing business only in Sri Lanka, then cross-border activity. So there will be exchange impact, because if we do imports and we have foreign supplier, creditor, so the conversion and the settlement time, there any the difference time gap. So there will be gain or loss. Export also same. Right? So remember, if that type of things is there could be this type of adjustment. Right? Exchange gain or loss. Right? And breakup of other income. This given that other income, that's the note. Profit on disposal of motor vehicle. And dividend income, that dividend income, there is another, the sentence or the detail, distributed company has utilized dividend income received by the company. That means company, we receive dividend, distributing company, utilize dividend income received by them. Right? So it means, so anyway, dividend income, because the company is doing manufacturing and exports, and they would have invest in other company or the share market. We don't know if it's share market or whatever thing they have invested. Right? They are getting dividend. Remember, dividend is part of investment income. So which is there in the financial statement. Right? Right? So this information gives, dividend when the company, the resident company is distributing dividend out of their profit, it is subject to withholding tax at 15%. Right now. Right? What is this? If that company is distributing dividend out of dividend income, that dividend is exempt to the recipient. That's the difference. If the distributing company has distributed dividend out of their profit, it is final tax for this company. This is the pin top. It's the final tax. So there is no tax liability thereafter. As for this information, distributing company has utilized their dividend income to distribute dividend. That means the dividend already being subject to withholding tax, and thereafter that dividend income they are distributing to another company. So recipient can enjoy the tax exemption. Right? That is exemption. Either it's the final withholding tax or the exempt income, it shall not be part of the business income. And then it shall not be part of the assessable income from investment asset. The exempt income amount and final withholding amount we are removing. So then it shall not be, right? So administration expenses including the following: depreciation charge for the year, right? Depreciation charge, amortization, that is leasehold assets, credit provision, right? These are provisions. You know that provision is the accounting provisions are not allowed for tax purpose. But that has already been charged and we arrive in the PBT, therefore that need to be readjusted. Right? The company has spent so much of money entertaining its prospective customers. Entertainment expenses. So that is also not allowed. Penalty, late payment of employee but the providing fund, the breach of written law, penalties, charges, interest, whatever payments to payment in respect of the breach of law, it is disallowed. Directors foreign traveling to meet foreign customers because they are doing exports. Right? The director has visited customer, foreign customer. Right? So repair cost of so much and the improvement cost. So you know that repair cost is fully allowed, improvement there will be a limitation. So then we need to work out, figure out what is the amount, maximum amount, what we can deduct in this particular year. Right? So this time could be expenditure there. So tell me that whether the director's foreign traveling expenditure is an allowable expenditure or not for tax work. Will be arriving the assessable income from this. Disallowed. When I use that, we discuss three sections, right? Basically, section 10, Under the main deduction, sorry, general deduction says whatever expenditure coming under the general deduction, we are not allowed. Very general thing. Section 11, main deduction. The section says, other than capital nature expenditure, that particular expenditure is incurred in the production of income, we can. Right, production of income during the year, we can incur in the course of generating income, and it should be around that particular year of investment, then we can deduct. But capital nature expenditure we cannot deduct. So there is a definition for the capital nature expenditure. And section 12 to I would say 19, that is special treatment. Right? Special treatment that need to be done for tax purpose. Right? Remember that. Right. So then directors they visited foreign buyers. Maybe they are going to attract and contract or sort out some buyers matter. So then whether that particular expenditure is allowable or not allowed. It is a allowable deduction. It is incurred in production of income. So repair cost, yeah, could be allowable. You have to check whether that particular asset is used in the production of income. That's the only condition, right? So penalty in case of the VAT assessment, that is not deductible expenditure because it is breach of law, written law. So there are some disallowable input VAT. That disallowable was happened because they don't have valid tax invoice. Can we claim? Not possible. It is disallowed. Right? Why? That is their ignorance or their negligence. So collecting of valid tax invoice is mandatory if the company is registered for VAT, right? So they can if they collect that tax invoices, they are entitled to get the tax credit. But as per the tax law, it's some special because of the application of the law. Other than this type of thing, if that input is disallowed, it is possible to do that. Right? Possible to do that. Legal charges obtain professional services from a lawyer. The invoice value was paid to lawyer. So legal charges, they have incurred some legal charges, maybe for some formation of a contract or some type of thing. Right? So they have paid that expenditure. Tell me whether we can deduct or not. Can. No. Reason? That's the point, yes. There's a hidden point given here. Total value has been paid. And remember, because that legal charge paid to a lawyer is an independent professional service provider. It's subject to withholding tax at 5% if the monthly payment is more than 100,000. So thing is that they have paid 2.5 million. If the monthly payment is more than 100,000. So then they have to deduct 5% withholding tax. They have paid total amount. So therefore, they have paid to deduct withholding tax. So as per the law, section 10 especially says that until they have paid, deduct and paid the withholding tax, they cannot claim this expenditure. This is a disallowable expenditure. Right? Distribution expenses include the following: advertisement, local media house fixed. Investment, the cost of an advertisement published in the newspaper to find a suitable land for setting up a new warehouse. Company has donated ₹500 worth of product to plant victims. Further, 600,000 has been donated to an affluent charity that maintains a children's home. Business promotion expenses of so much. This includes 950 worth of gift and hampers given to suppliers. Right? CSR expense, that is corporate social responsibility project, expenses to wine. This is product donated to a temple for their power supply project. So, what do you think? First one, advertisement expenditure. Hello. So, they are trying to find out a land to set up a warehouse. Right? So, second thing is donation. Yeah, in this case, both donation, when we are work out accessible income, that both this donation is not allowed. That is under section 11. It says expenditure incurred in the production of income. So these expenditures are not connected to the production of income. So it is disallowed. Right? So second thing is CSR expenditure. That is also a donation. So it is not to what is this to charity. They are not given any information. So that is also not incurred in the production of income. So and also you can make any assumption it requires, right? Right? Unnecessary assumption but you just mention that, right? Because here that I have mentioned here that but if this they have wants to find out what the land. So in the detail list they are giving the purchase of land to be related to that one, right? And the use in the business, right? So thereafter, giving the detail of asset, right? This is the note from what the financial cost is at the cost, right? This is cost. So for your purpose, it is required using the cost of the depreciation basis. More or less, the cost means the depreciation basis, right? So balance as a 1/4/2023 and it is 31st March 2024. So during the addition or acquisition and disposal. That is cost. This shows cost. Right? It's thereafter it says motor lorry which was purchased in the year 92 at cost of rupees 2.6 million has been disposed in March 2024. This lorry was used for delivery of goods. Right? Assets used depreciable assets used in the production of income. They have disposed during the year. So then remember we had worked out the super charges of balancing allowance. The tax impact. And during the year, company purchased a new accounting package. Computer software. And its useful lifetime is estimated to 10 years. This was developed by a freelance software engineer and total service fee was paid in cash. Right? You know that accounting software means what type of class of asset? Intangible asset. So how we can claim capital allowance? Can we claim capital allowance first? Yeah. Generally, accounting software that is used asset used in the business. Right? So what the time period? In case of if they have given the useful lifetime or the period of useful lifetime, if it is not, then how many? 20 years. 20 years, right? So, but remember, there is another point here. It says that they have paid to a software developer in cash. In cash. Right? The total amount is 600. If any person making cash payment to acquire asset or make an expenditure, which is more than 500,000 in cash, if that part cannot be considered as expenditure or the part of an asset, cost of an asset. So then this asset is not entitled for capital. That's the meaning. As per section 10, it says any payment making other than using by check, account pay check, pay order, bank transfer, debit or credit card. So that particular expenditure is treated as not part of an expenditure or the part of cost of an asset. Right? That is the section. So motor car. the motor car, that they are giving that motor car to staff, right? And they are telling that okay, non-cash benefits they have properly recognized. That means they are providing cars to staff members. They can use that motor vehicle, but for that benefit they are recognized for the APID purpose. But for the capital losses purpose, motor car should be treated as a road vehicle. So then it is not entitled for capital loss. Or the in simple, if I put it in this way, that any motor car or the Jeep that is used for the traveling purpose, not entitled for capital loss. So other assets they have purchased in 1920, and right of use asset, right? 5 million. Packing credit loans, that credit the interest, finance cost and income they are given the details. Packing credit loan and construction loan building. Construction was completed 25th March. That has been already capitalized. Building, right? And building was occupied from 1/4/2024. So it's due to the triggering point for tax part. What is that? They have a penal loan, right? But the intention is to construct a building. As per the here, so there's a building. They have constructed during the acquired purchase of the finance. They have constructed a building, right? They have obtained that loan to construct that building. It says building construction was completed 25th March 2024. Completion has been done. So that means that building is available for use, right? For the business. But the building was really used for the business from April on. So that means that particular interest is, but so say what the section says, section 12 says, interest cost can be deductible if the borrowing is used in the business. So otherwise, if the borrowing used to purchase an asset should be used during the production of income. So this building has not used during the year. Our year of assessment is 23-24. They have not used. Therefore, that particular interest cannot be deducted. Right? It is this one. Next is. So it's you can give this type of thing. So because as per the financial statement, they have capitalized or they have recognized the building. They have not. That means capitalized that particular interest cost. Reason could be because they have recognized assets by 25th March. The settlement may be thereafter. Right? So once it's recognized or they can capitalize, they have not got capitalized that one. Ideally, it should be how they should have that interest cost should have part of the cost of an asset. They can capitalize for the tax point of view. Once they use for the production of income, we can claim capital. Right? And also, other point is given hint that that particular building, the 10 million building is still we have not used for the production of income. Therefore, it is not possible to claim capital allowance. Assets owned and used in the business, we can claim capital allowance. Right? Remember. Interest income from treasury bill. Interest income from treasury bill. So it is treasury bill investment means the part of portion of what is that? Investment income. So interest. So then ideally we have to remove from the when we work on principal income from business, we have to remove that part from the profit before tax, and we have separately that work out the asset income from investment. And interest income in saving accounts maintained at, for example, bank unit cost rupees so much. But they have a saving account. So ideally, because they are doing export, So they are receiving interest income on that special account what they have opened in the bank. Normally, you know that exporters are opening, they are maintaining accounts in the bank. Which unit under which unit? CPU, right? So that interest income on that foreign currency deposit. So as per the tax law, it is exempt income. It is part of investment income, but it is part of exempt income. When we work out the taxable income from investment, we have to remove. Exchange gain on conversion of income and expenditure record. Expenditure record 2 comprehensive income was rupees 2.5 million and translation gain on non-current assets and long-term liability was rupees 1.5 million. Something, right? Remember, as per the public ruling given by the Commissioner General, because the company is reporting currency is USD, in such case, the income and expenditure related exchange gain or loss should be considered as the cost of part or the gain of the part of transaction. Asset recorded, non-current asset, and long-term liability recorded. Out of that, is there any exchange gain or loss? That can be ignored because it says that spot trade should be used, and when they are recognizing any disposal or loss, you can recognize that one, right? Right. And additional information they are giving amount paid as the gratuity. So payment we can deduct because gratuity provision we are disallowing. The company has paid rupees 9 million quarterly installment tax. That is not there in the income statement, right? Remember that is tax credit. Second rate loan obtained during the year was 9 million. Now the detail has been given to you to work out. Take capitalization. The maximum amount of finance cost what we can deduct in this computation. And it says that loan has been fully settled. That may be the reason that interest they have recognized. But maybe there may be another grace period, another period for them to settle that loan, but they have settled the full loan after recognizing the asset. Right? During the year, lease rental of rupees 650 has been paid on the assets under ROU category. That is ROU asset they have paid. What is lease installment? So the rental we can claim. The amortization part we have to disallow. If any interest, that is also lease interest I have not given. It should be ideally come under the lease interest cost. So that is also disallowed. Is that clear? Right. So that's the way you have to analyze the question. Right. Right. So basically, remember that section 10, there will be 5 or 6 adjustments and also capital allowance. Right? 2, 3 adjustments. Definitely there will be the question paper. Right? Out of that, the section 10, what the expenditure disallowed. Basically, there are some, you know, that directly we can recognize provisioning, entertainment, legal, and what the payment for the penalty and all those things, breach of law, and the WHT deducted the expenditure and cash payment. That could be tested. Right? So, shall we work out this question? Right. So basically, the computation of the income will attract more marks, right? Because and give more marks for that. The computation of the income, taxable income, there will be a few marks because there is no mark adjustment. That's the computation of tax also few marks. Right now, computation of liability, tax liability. Based on this tax, just application of the rate and work out the tax liability and deduct the tax credit. Straightforward, right? The more mark is allowed allocated to the computation part of the taxable income from business and So we have called the computation in LKR and the information given in LKR. Computation first part is source of income. Ideally, it should be assessable income from employment, right? Right, but there won't be any assessable income from employment because I am not testing that employment income. Well, income from business, how I am doing. So I am doing a working for that one. Working one. So if that's the employment income, it should be working one, then this should be working two. As per income from investment, when we read, we show that there are as per income among the investment income, so therefore we have to work out that is coming under working two. Other source, penny, right? That is assessable income. So then, how is this is the computation, right? So then, workings we have to separately do and take the figure here. So we call this is total assessable income. Total assessable income. Right? So then from assessable income we have to work out the taxable income. So deduction. Deduction under section 52. Qualifying payment. So under qualifying payment, we have two parts. one thing is donation to approved charity, other thing is donation to special institute, governments and funds. Right? Another part is any special donation. I mean, just like in film industries, and donation to some other parties we discuss, right? But in the examination context, basically we are testing. I am testing donation to approved charity and donation to government. So because if I want to test other part, I have to give that film industry, right? Not practical. The entire question should be on the film industry. So therefore, I am giving a general question, general industry. So anybody can do. So qualifying payment. First one is what is donation to approved charity. Second thing is donation to government. That is when we are reading the question, you could see that there are some donation. Most of donations are not coming under the qualifying payment, and one or two things that coming, but it says it should give the details of the donation. Should be, but in case of the qualifying payment, donation to V2DITA under the qualifying payment. In case of the what is the donation to approved charity, what is the definition? It will be cash donation. First thing, right? First thing it should be cash donation, and that donation to be made to charitable institution. The definition is charitable institution is approved charity, which is in the providing institutional care for sick or needy. That should be there. That information should be given. Right? So that is only cash donation. In case of the other government and institution, that is cash or goods donations are allowed. But the details also need to be given. Remember that donation to approved charity, there is a maximum limitation also. The maximum limitation in case of the entity, the 1/5 of taxable income of 500,000, whichever is, the lower amount we can deduct. So there you can write that note. What is that? Cash donation. Cash donation. To charity. Maximum limitation. This need to be, you have to check. And it should be cash donation. And to be approved charity. And there's a maximum limitation. Right. So keep some space there. And ideally, in this case, actually, this question I have not tested donation to government. Otherwise, that should be right. So we'll put that in the format. There's a specified institution of funds by the environment. IRB access. Let's say donation to a high national institution, Buddhist and Pali University, and funds. It says what are the funds, right? The detail should be given. There is no maximum limitation. Cash or other. No limitation. Entire amount we can deduct. Okay. Right. consider that part is called taxable income. Taxable income, then computation of tax. So apply the rate and work out the tax liability. Taxable income into tax rate, right? Remember, here they have differential tax rate or the reduced tax rate we can apply for that income. Right, or the higher tax rate we have to separately apply. And in case of the disposal of investment property, investment asset, property investment asset. So then tax rate we need to check. But currently in Sri Lanka we have one flat rate other than BOI company, right? Flat rate is 30%, and the disposal gain on the investment assets also right now is taxed at 30% in case of the company, right? Right. So then once we work out the tax liability, that is gross tax liability for the year. Less tax payment, tax credit, right? Under tax payment or tax credit, you know that tax credit, under tax credit there could be withholding tax or the AIT, not income tax paid at the source. Simple example, I can say that in this company they have made an investment in the saving account, right? When the bank is making the payment, they are deducting taxes. Other than if it is the income is exempt, but this is, in this case it is foreign currency account, so then the interest is not exempt, so therefore they cannot deduct withholding tax. But if it is maintained in LKR, then when they are making that payment, they have to deduct withholding tax. If they have deducted withholding tax, we can deduct as tax credit. Remember that income we have to consider for tax computation in the gross term. We have to gross up the interest and we have to work out the tax as the income. And withholding tax we can deduct advance income tax, so then final. Final WST we cannot claim. Reason is that final any income which is subject to final withholding tax cannot come under taxable income. Therefore, it is not there in the taxable income. Therefore, we cannot work out the tax liability on that. The tax liability, whatever on the final withholding amount, we have then and there we have already paid. Right? So we'll say installment tax payment. Yes, minor refund. Right? That is the format that will be used in the examination context. Right? So then working mark. So we directly go to the working mark. Recap officers. We use this statement. Right? Okay, before tax, how much? The profit before tax? And for tax? How much? 45, 950. 50. 950. So it's come to the plus side. If it is loss, it goes to minus side. Right? So whether you are knowing or not, you have to do the correct adjustment. Right? In this format. So any deductible amount you can put it here. Disallowable amount you can put it here. And then we have to add to the profit. Tax loss will be reduced. And once you do it that way, it's automatically giving the correct answer. Right? But don't like a machine, don't like do that one. Try to understand even after exam. Right? Why we are doing that? That's the important point. Why we do that? Right. So profit before tax is 4-5. So I answer there not necessary this information. I mean not much relevant for the tax right now. Thereafter it says profit on disposal of motor vehicle 516, right? So that means that profit is there. And for the tax point of view, we are not accepting that profit. So therefore, we have to remove that one. 16. Right? When there is loss, it comes to plus side. Right? Then it's even. This part of it is showing up. Therefore, we are removing here how much? Five six five zero, right? It is there. We are removing. So now that whatever income side is, which is relevant for as per this one, this adjustment for this one. Remember, computation is as per income from this one. If there any other source of income, we have to separately work out that income. Right? Okay. So thereafter administration expenses. As per the given information, they have already charged that expense. It says depreciation. Provisions are disallowed. Disallowed means we have already deducted. When we are arriving the PBT, disallowed means we cannot deduct, so therefore we have to add. Amortization. That's also provision. Gratuity. 4.2 million. Then entertainment expenses. Penalty. Non-compliance with written law disallowed. Foreign traveling. Business expenditure. Business related. So therefore, it has already been deducted when we arrive to CBT. Tax also, for the tax point of view also we can deduct. So therefore we need not to make any adjustment. Right? Remember, if any expenditure which is allowed, which has already been deducted when we arrive the profit before tax, as well as for the tax purpose, it is allowable deduction. So then there is no any amount coming to the plus side or minus side. Okay. This is the right expenditure. Continuing. Repair cost. Repair cost 275. That has already been deducted when you arrive in the PPT, and if it is incurred for the, what is that they have incurred for the existing machinery. That machinery is used for the production of income, so we can deduct, right? So improvement cost. Improvement cost 2.5 million. So improvement cost in general terms under the but the main deduction says capital item, so we can deduct, but under separate section, it says section 14 or the 14 says how much we can deduct. Right? So therefore first we add back all the things, thereafter we allow the maximum amount. How much is saved in case of the asset? Which asset? And then building and permanent nature structure is limited to 20% of the written down element as of the previous financial year. So it says machinery. So now it's important we to consider machinery. So how much machinery is 50 million. That is cost. That's not the written down element. Remember, that's cost. Right? So what's the written down element? As of previous financials. End of the last the year of it. They have purchased that one in year 1920, right? Yeah, 1920. So then cost 50 million. They would have claimed capital losses in 1920, 2021, 20, 122, 22, 23. So that means 4 years they have already claimed capital allowance. It's the 5th year, right? So what the written down value as of previous year of assessment? They would have claimed 115.10, right? That is the capital allowance that they have claimed. Right? So now what is the written down value? For 50 million, if we claim that capital allowance go together 4 years, that means how much they would have claimed? 40 million claim. Now 10 million is the written down value as of the previous year. In electricity, what is that? It's a 5-year depreciable asset. 4 years already has been claimed, but there is no addition in between. But the last year capital allowance is the written down value as of the previous year, end of the previous year, right? So 10 million. On that, how much we can deduct? In $100. How much we can deduct? 20%, right? 20%. So what's the amount what we can claim? 2 million. Now that 10 million is claimed. How much is 10 million claimed? Capital allowance, this year capital allowance, here, right? And now we got this 10 million. Right. So then balance by how much? 500,000. It shall be added to the in the written down as of end of this year. Then ideally in this asset there will be written down at end of this year, right? We are fully claimed. Then next year we have to deduct that one based on the what is straight line base or whatever. Active style up that could be the applicable base, right? Right. So that is improvement cost. So now Japan this thing is fine. Around it says any question? Then it says penalty. What assessment? Again, non-compliance is written law. Not allowed. How much? 55,000. So it has already been deducted, but not allowed for tax purpose. And disallowed VAT. Non-compliance, that is also 125. That is also not allowed. Legal charges. OWS has been deducted. So AIT. So therefore not allowed. 2.5 million. So that is about the administration cost. Then what is that? Distribution cost. Under that advertisement expenditure. The acquisition of asset, yes, we can. The acquisition, the recruitment of employee, that type of things. Right, disposal of asset, that can be deductible expense. Right. Other than that, if it is not relevant business, we can disallow. But here it's also just like purchase an asset directly connected to the purchase of an asset. Right, and the real thing. The whatever expenditure incurred to bring the asset to present condition will be capitalized, right? So in this context, we'll allow that what the land is used for the, assuming that it's a capital asset used in the business. Donation. Not incurred in production of income. Both 500,000 plus 600,000, 1.1 million. Business promotion expenditure. DSR expenditure. $2.5 million. That's all about the distribution expenses. Then they are giving the details of PPE. Need to work on the capital allowances, balancing allowance and as per charge, right? So capital allowances will work out separate notes under separate notes. As of 31st March 2024, right? Remaining years. Allowance. Like land. So as per the given information, they have not disclosed. 25 million. 2019-20, they have purchased a 25 million. Balance as it is there. That is not entered for capital allowances. Building. So sorry, another land. 2023-24, right? Given here they have purchased another 5 million land. Voila. Building. So 50 million they have opening balance. Due to the no disposal, that same 50 million should be there. That building has been acquired 1920. How much? 15 million. So normally how many years they can claim capital loss for a building? 20 years. Right? So now they would have claimed capital loss 1920 or almost 4 years they have claimed. Other 16 years they can claim. Right? So that means remaining years are 16 years. They have already claimed 4 years allowance, right? So how we should work out? They have claimed capital allowance for how much? Three million. They have claimed 3 million. That means written down value for the depreciation basis. Huh? 12 million, right? 12 million. Right? 15 million minus 3 million. So they can claim capital allowance, right? 16. How much? 750,000 they can claim. So billion during the they have added 10 million. How many years they can claim capital allowance? 20 years. What amount what we can claim this year? 5 million. 9,000. So that's what I previously told them. As for this other note, says that building has not yet used for the production of income. He cannot claim capital allowance. Take a note there. Not use. Not yet used. Then order lorry. They have purchased in 2019, 20, how much? So during there they have disposed 2.6 million worth of motor. So that means balancing is 24.8. This is the last day they can claim, right? 5 years they can claim. 1920 they would have claimed. 2021, 1, 2, 2, 2, 3. This is the last year. Only 1 year to go. How much? $90,440. That's the remaining balance, right? That's okay. Already claimed. 19 million. 44.
Here. 440.
So balance amount, how much?
$4 million 840.
4 million?
860.
860. That's the written down earlier as of end of this year, and that is entire thing they can be done. That's the disposal of storage. Sorry, how much under sales proceed? $4,950,000. Yes. That's written down below. Cost 1920, how much? 2.6 million. So then depreciation, the capital loss they would have claimed. How much? Right, right? 1 million. You can try 20. So the dividend for 5 million, how much? 2,230,000. What is that? That's the interest amount over the sales proceeds, right? Sorry, excess amount, the written down excess amount we received as sales proceeds as against the written down earlier. So that means there is a double charge. So it's the disposal profit as per tax point of view we call acceptable charge. That need to be added to the taxable income, right? Two, 430. Calculation is not completed. Then modify. They have purchased in 24, 25, 23, 24, 25 million. What's the entitled? Then obviously quick match. So 2019-20 they have purchased 2.2,150,000. They can claim over period of 5 years. It's the last year. So we have another remaining year. Remaining year, 1 year. How much? Sorry. They can claim 430, right? Or they have claim altogether for 4 years, another 1 year to claim. That's it. So during the year they have purchased office equipment, how much? Office steel. So also for 5 years, right? How much? 92,000. Computers. 1920. Another 1 year to claim capital losses. That means 4 years they have already claimed capital losses. Another 1 year to claim. How much? Wait, 6. Right. Software. Ideally, they can claim over a period of how many years? It says 10 years. But as for this one, that has not been, that has been paid in cash. Therefore, it shall not be considered as part of an asset. So, ideally, we cannot claim capital asset. Right? We cannot say that. So that's all right. Capital asset, that's all right. The capital asset are taken in claim. It should be there, right? Shall I write down? Scenario. 1920, they have that 250 million. We can claim another 1 year. Ideally, how much? 10 million. Right? 10 million we can claim. So improvement cost, we are at the end of the year. It's down. Balance sheet. Yeah, it's not that we are adding that balance improvement cost to the written down value and then claim capital. No, that's not the case. First we claim capital amount, then the written down value as of the end of this year. So that amount we are adding the excess improvement cost. That's how it goes. That clear, right? That is clear, right? If I mean to say, we have that improvement cost, excess improvement cost, or the improvement cost above the maximum limitation what we can claim for the year. That improvement cost should be added to the written down value at the end of this year. Written down value means after deducting capital losses for this year. Remember, right? It will be there in the question well. Practice that on again, right? Right, how much? I really say because anyway that we are claiming some amount as improvement cost this year. The remaining part should always close to next year. That's the meaning. That's the intention. Otherwise, they would have allowed that part also. It says you have to add the excess improvement cost to the written down value at the end of this year. Written down value means after deducting the depreciation allowance for this year. So what's the total amount?
16 4 16 418.
16 418. 418.
Okay.
Sixteen to 1, right? That is capital R. Software, why we have not claimed? Reason is that for the development of software, they have paid to the independent software developer. Right? Software engineer. Right? They have paid total amount to that particular person in the form of cash. Any payment made in the form of cash, if it's more than 500,000, it shall not be considered as expenditure for the cost of an asset or tax purpose. Therefore, there is no time to claim capital loss. Right? Yes. Claim. Therefore, we cannot claim capital loss. That's the meaning. The tutorial under the business tax computation, you can refer to the disallowable expenses under section 10, the page number 29. The tube. You made the PowerPoint presentation but I had to. The introduction to taxation, under that we discussed the business income. That is the excess where a person pays to another person a sum of money amounting in aggregate of rupees 500,000 or more. In this case, 620,000 they have paid. Or in respect of a single transaction, it's a single transaction. Or in respect of a series of single transactions. Transaction is single, there are a series of things. Relation to one event. Otherwise than by way of, other than by way of an account pay check. Should be payment should be account pay check. Account pay bank draft. By the use of credit card or debit card. Electronic payment system through the bank account. Any deduction shall not be allowed in respect of such payment. So that means expenditure, in case of the expenditure, it is not allowable expenditure. The amount paid shall not be considered as cost of an asset. That cannot be considered as a cost of an asset. That is. That's it. So indirectly says that cost cannot be considered for tax purpose. Reason is I will tell you what the intention is. In Sri Lanka context, the informal market is more than 60%. Most transactions happen under the hand, under the carpet. So them to pick that one now, if they have introduced, okay, you have to route through the transaction through bank system. Otherwise, for the tax purpose, it is not allowed. Another discouraging cash transaction. Take them to the system, formal economic system, formal market. Is that clear? Right? Don't move. You need to put that to that. I just want to the example. Right. Right. It could be for the expenditure, right? Even expenditure. Say simple example. Say that they have paid that lawyer, but in that case they have not deducted without tax. They have paid lawyer to in the form of cash. That expenditure also it's incurred in the production of income relevant for the year of first month. But as per this section, it is this one. Right? Even expenditure. It says expenditure, any deduction shall not be allowed in respect of such payment. Any deduction. The amount paid shall not be considered as cost of an asset. Okay. In case of the acquisition of assets, we cannot consider as cost. In case of the expenditure, it shall not be treated as expenditure. That is for tax purposes, right? But for the financial reporting purpose, we would have recognized that. We have recognized that asset, right? That's why they have recognized. Okay. That's clear? Yeah. So they have given I have given that ROU asset, but in the next the item number 5 is ROU, detail of ROU assets under the asset 2 thing under item 5. But first one is for the acquisition of asset. In the case it says that 5 million is there. It's a ROU, right? ROU assets we cannot claim any capital losses. Is there any interest cost that shall be treated as disallowed part? We are not allowing, but the installment payment we can allow. Right? Installment payment. ROU means asset under the operating lease. Right? Just like renting, have a long-term rent agreement. So we recognize asset for the financial report purpose under the ROU. So ROU assets we do amortization and we charge interest. How we are doing the accounting treatment? We have to ascertain the percent value of the lease rental. That shall be the asset value. Difference we are recognizing as interest when we are making the payment and other parties go through a lease credit. Right? Monthly we are paying for the and periodically we are paying the lease installment. So that installment we can recognize for tax purpose as a deductible expenditure if the asset is used for the business. Right? So interest and amortization is not allowed. So next one is credit loan, banking credit loan, and the loan interest they are giving. Right? So first we'll remove that total. First loan. How much? Is the total interest cost, right? Yeah. It's 3 million. How much we can allow? So we'll do another working. 3 million. How the section will say any borrowing that is used in the production of income, we can deduct the interest cost. Or the borrowing should be used to purchase an asset. The asset should be used during the year for the production of income. As for the franking credit loan, it is used for the production of income, so it is allowable. Then second one says loan interest on construction, that is construction loan for the building. $1.2 million. Then allowable interest cost 1.8 million. This company maximum amount. How much we can claim? Allowable finance cost. Divided by cost of borrowing. Cost of the instrument. Multiply by 4 times issued share capital plus reserve. At the end of the year. Right? Have they given the borrowing cost? As the examination content says that they have not given that information, so you can make a simple assumption that you have to anyway work out the allowable finance cost and make a simple assumption that this amount does not exceed the maximum deductible amount. So then you can deduct entirely, right? Otherwise, you have to work out this one. Right. So then this is the amount. Allowable finance cost is 1.8 million. Relevant borrowing, how much? As they given. Yeah, second credit card loan is 9 million. Right, 9 million, right? Into 4 into issued share capital and reserve, how much? Tell me. How much? How much? 9 million. Your share capital?
Share capital 2 million. Share capital 2 million.
3.2.
Okay, 2 million plus. Reserve? How much? 50 million.
Minus 30. The revaluation minus 30.
Revaluation reserve we cannot consider, right? Reserve means they are given the definition. Reserve means other than revaluation reserve. So we cannot get the revaluation reserve. Therefore, this is as of 31st March 2024. Remember that. I mean, as per this one, they have that profit before tax 45 million. They would have distributed dividend after transferring everything. That reserve is how much? 2 million. 2 million, right? Correct. Okay, what is the amount? What we can deduct? Maximum?
Three point.
3.2. Up to 3.2 million we can deduct, but the allowable finance cost is 1.8 million. So then entire 1.8 million we can deduct. Okay, correct? Ideally say if that borrowing is more than 4 times of the issued share capital and reserve. Borrowing is more than 4 times of the issued share capital and reserve, then there will be a limitation. Otherwise, so 1.8 million we can deduct. Okay, is that clear? So okay, then loan interest income on treasury bill is there in this one. Next one income. Therefore, we have to remove how much? 4 million.266. 2266. So then exchange gain on conversion of income and expenditure recorded to comprehensive income. So remember the P&L related thing, that thing P&L related item. Any conversion gain because they are reporting currency is USD. Therefore, it shall be considered as part of the transaction. It is anyway it should be. So now I just not expired. But they are this we can remove. So please read that exchange, the public ruling given for the exchange gain and loss, right? I have shared with that, right? Ruling? I gave it. So then, ready to payment? Payment we can claim. Quarterly payment, that is tax credit. It will be coming here. $9 million. What we have considered, enter. $50. That's all. Okay, what is the plus side and minus side? 600,000. The balance is taxable income from business. But the side and my side different. Different shall be considered the income from this.
$36
36
147.
147. Yeah, that is correct, right? 36 147. Right? Right. So then taxable income from investment. We noted that where that the one thing is one category is dividend. Subject to AIT, right? Generally subject to AIT. How much dividend? 5650. That is actually insane. No acceptable dividend. So second one is interest. On treasury bills, how much? Over here. No exemption, no, not subject to withholding tax by now. Today foreign currency. Six. That is exempt. Therefore, no accessible. That's only interesting the investment income, right? But examination, Dubai, one thing is dividend, another thing is interest. Million. So here you don't have what the one amount here. We have only 4 million. That shall be the acceptable net income. Say rent income or whatever thing is there. So we have to work out separately. Right? So then as the total acceptable income, $4127, right? Correct? Then donation to accrued charity. How much? Can you read the donation part? Good. It's not a contract payment for donation. Accrued charity. Cash. Yeah, that could be the children home, right? Approved children home. If the approved charity institution क्या, right? 600,000. The CSR. It's also not a qualifying payment. So this is the amount, qualifying payment. Subject to maximum limitations. Is 500,000. So taxable income obviously more than 500,000. Therefore, maximum limit we can claim. No any other donation. That's all. What the total taxable income? 4147. That 4147 is correct, right? Taxable income. So okay. So then taxable income. Three nine six four seven. Correct? So in this, there are no special tax rate application of a special tax rate. So it's tax as 30%. How much? How much? Tell me. One by that was and what the tax? 11,894 100. 100. Right. No any other thing. So now withholding tax. Remember here, and the examiner can give that interest which is subject to withholding tax. So then withholding tax part we can deduct here. Remember when we have worked out taxable income from investment, gross interest income need to be considered. But say dividend, dividend is not coming here. Why? It is final withholding. If there's a rent income which is part of investment income, so then 10% could be there. Right? Right. So then 9 million we can deduct. $2,894,000 balance tax need to be paid. Okay. Yeah. The 40 mark. Right. So basically the mark will be allocated to the computation of taxable income. So 3 marks allocated to here. And it's a matter of the application of taxation and this thing. It's still an extra comma, right? Taxable income from business because here this is also there is another adjustment here. What is that? This one. Marks. And things used to this thing. Here will attract at 5 or 6 marks. Likewise, right? Okay, can I continue? Continue. Right. Basically, that's the first question. Right. And in that first question, there are another part. One part. Right. So I can. What? Global measure to break on I want another 15 minutes to discuss some data that is social security contribution because it is not there in the syllabus. There's NVD right now. We don't have NVD, so we'll have a small discussion for a small part, and then the tax planning part we'll discuss. Right, tomorrow also we have another session, and tomorrow we'll discuss the value-added tax and other things. Right. Take a break. So the when your exam is scheduled on 31st, right? 31st August, right? Main karane please take ko. There should be 17. Should be 17. Oh. Sini budget sharing. Video අන්න ගොඩක් අය ටයිප් එක කරලා තිබුණේ නැහැ මේ කම්පියුටර්. අයත් කරලා තිබුණේ. කොහොමද එන්නේ? ඉවර කරපන්. කියන්නේ කැල්කියුලේෂන් කැරියව පාටික තිබුණේ. අන්නේ. only the in the
Excuse me, sir. Cannot hear you.
Hello.
Yes, sir. Can you hear me? So the conversation gain එක ගන්න එක අර comprehensive income statement එකේ allow කරන එකයි financial position එකේ disallow කරන එකයි reason එක පොඩ්ඩක් කියන්න.
So it says in case of the, I mean, you know that in the for the accounting reporting framework also we do the same thing. I mean, in case of the conversion of financial statement which is prepared other than LKR. So any conversion gain or the loss which relate to the transaction, that means the income or the expenditure, we consider as part of that cost of the transaction, right? Say when we have already purchased something and on the purchase we recognize the purchase to the income statement, the purchase that there is a transaction gain. So that shall be considered as a part of gain on the business, right? It shall be part of the assessable income from the business. I mean, there is no, we need not to separately recognize what is the gain and loss, because it's a matter of converting the transaction and the USD accounts, in this case USD accounts to LKR, right?
Okay, sir.
Because of the asset which is generally recorded at historical cost, at the realization we are recognizing the gain or the loss. That's the treatment. Is that clear?
Yes, sir. Yes. So if the assets are not realized, then we shall not consider, right, sir?
Yeah, it's a matter of just conversion. But in case of the general case of the transaction which is recorded to the profit and loss account, we have to consider that one. Otherwise, no. That is in case of the financial statement prepared other than LKR. But in case in reality, if somebody is preparing financial statement in LKR, then we have to consider each and every item. In case of trade and non-trade, say working capital, asset represented working capital, then we have to consider it. Right? Likewise.
Okay, sir. Thank you, sir.
There's a guideline. I will put that. I all in the classroom, but I will share that. I will share. And shall we look into the other question? The same question and the part B says the joint land to the active location of Mr. Private Limited belongs to Srilanka Private Limited. Currently, this company is not operated, and they are going to sell the land. There was an offer came to Pinton to purchase the land at a price which is comparatively low. Pinton Private Limited is evaluating the decision. Currently, company has no plan for expansion of existing business. However, marketing director has proposed following option. So purchase the land at ₹50 million and resell the land after 1 year at ₹75 million. Profit can be utilized to distribute dividend. Purchase the land and lease out to a prospective buyer. Monthly rental will be ₹1.5 million. Purchase consideration can be settled from a bank facility available with the company. The board is seeking the tax implication of the purchase of the land and on above option proposed by the marketing director. You are required to advise the board of interns on the application of possible taxes on purchase of land and on above two options. Correct? So, ideally they are going to they have an option to purchase the land. So, but right now it says they don't have any business expansion. That means if they are purchasing that land, that will be kept as investment asset. Right? That will be keep as investment asset. Right? And the ideally they are going to resell or the lease out, rent out. That's the two options they are seeking. Right? In first option, they are telling that it's, they are keeping maximum 1 year, thereafter they are going to resell. They have a prospective buyer, maybe. So then the profit earned out of that transaction could be utilized to distribute dividend. So in similarly, you have to use your general understanding about the taxes also when you are advising this thing, right? Not expecting. I'm not expecting you to give all the theoretical background. Simply what they are going to purchase the land and sell. One thing. Other thing is they are going to purchase the land and keep as a investment property and getting rent income. And two options. So if somebody wants to purchase a land, first thing is tax implication. They have to evaluate. They have to consider there will be stamp duty. That is one thing. If you are purchasing a land, there will be stamp duty. Right? That is one thing. They have to pay stamp duty. Right? Second thing is if they are going to purchase and keep some period and thereafter they are going to sell, it shall be a capital asset, but it's not in the business. Capital as part of investment, disposal will be liable for capital gain tax. Right? So that is there. And also, if they are distributing dividend out of that profit, so that will be liable for AIT or the withholding tax at 15%. Right? So here 3 points. Right? Thereafter, if they are going to going for the lease option, so that means they own the property and then they are going to lease the renting option. So on the lease rental, they will be liable for tax. Right? We have to work out the income tax and we have to pay tax. Tax rate could be 30%. Here, capital gain tax rate could be 30%. Right? And when they are paying that particular party, if they are doing, if they are making that payment, there will be withholding tax. They are not income tax at 10% because monthly rent is more than 100,000. Right? These are the things that need to be considered. So on the purchase, there will be stamp duty. Right? That is the general use. I thought you have that. Right? If you are purchasing a land, the immovable property, that there will be stamp duty, ideally 4%. I'm not expecting you to work out the stamp duty. Is just a given advice, the general advice how what's the tax application of tax. Okay, right? Will there be value-added tax? Liability. So buying and selling of the purchase and keep as an investment property and disposal, there won't be value-added tax. Why? Only land. There should be improvement. But on the lease rental, yes. If the company is registered for value-added tax, because in the above paragraph they have given and the introductory paragraph to the company says they have 900 million turnover. I mean they would have registered. They should have registered for VAT. So therefore that lease rental will subject to VAT. Right? You can put that thing. Tax then can be allocated. Right? Put it in a nice way, right? Because you are supposed to give a advice to the director, board of directors. Right? Just like the option 1, purchase and keep an asset. Keep as an keep for a period. This could be treated as an investment for income tax purpose. At the disposal point, it shall be liable for capital gain tax because the capital asset keep as investment. So realization gain from the investment asset shall be liable for capital gain tax at 30%. At the purchase consideration should be including stamp duty on the acquisition of land. Right? It is not liable for value-added tax by only land. So second thing is leasehold thing. So lease installment will be subject to withholding tax when the payer is making the payment, but that withhold tax can be, or the advance income tax can be claimed as tax credit. It's the profit on this thing could be considered as a part of business income, and its tax would be 30% on that. Any expenditure we can deduct on the incurring on this activity, right? 1.5 will be liable for value-added tax. They have to pay back on that. When they are deciding the lease rental, they have to consider that, right? Is that okay? Okay. So that is basically the question number 1, and question number 2 we'll discuss tomorrow with the value-added tax. And I want to discuss the computation of value-added tax. Very similar question will be discussed. And question number 3 is about the non-resident tax computation. Again, non-resident liability of non-resident. So definitely that what is the relevant article will be given in the paper, right? The countries is involved in this. Is just to say whether profit arising from the hotel project and these things is whether he is liable for tax. So first thing in such case, just as we discussed today, I explained to other batch. So I mean, say whether an non-resident is liable for tax or not in Sri Lanka. So that is as per first thing as per domestic law. We have to confirm that whether this entity or one entity and another person is there, whether they are resident or non-resident. That's my level provision. So if they are not resident, then we have to check whether there is a source in Sri Lanka. Right? Non-resident person, if having source in Sri Lanka, then they are liable for tax. That is the next part is what is the category of income? As per the article 7, it's business. As per the article 12 or like 15, we have to mention that. Right? This will be a very easy question. Why relevant article only I am giving? If the article 7, article 7 giving, and it's coupled with article say 15, I 15 also give. Right? So basically, article 5, creation of the recognizing of permanent establishment, and other relevant article will be given. That question will be much easier. Not expecting the computation is not much expected, but if you can give some sort of thing, that will be a lot. I mean, you will, your side, it will be easy you to figure out. Okay. Right. And because two parts there, some part of there, so the recognition of that part will attract. So question number 4 and there will be another part. The question number 5 also I am planning to give that is optional. Out of these two, you can select one. It's just this type of thing. So they are also coming as a non-resident company to set up a business in Sri Lanka. So what will be the tax liability? Whether they are liable for Sri Lanka tax or not. So there is asking the general question again that what is the tax applicable in Sri Lanka? So say this is coming as a branch of it, so then there is a permanent establishment, so then it should be considered as a distinct entity. So all the relevant taxes in Sri Lanka is applicable. Right? Second thing is a subsidiary company. So if you are setting up a subsidiary, remember subsidiary means incorporate in as per the law, written law in Sri Lanka. Right? Another law in Sri Lanka. So then it is definitely be a resident person. Resident person. They are not bothering about who are the ultimate owner of that company. Right? It's not matter. Why? If they are incorporating a separate company in Sri Lanka, so it's a definitely resident company. But if they are coming as a branch office, then is a non-resident. Non-resident person having a fixed business place in Sri Lanka. Then that fixed business place we have to consider as a separate entity, and we have to work out, but person still is non-resident. That's the difference. I take the very the common example, but the example HSBC. Yeah, coming and doing business in Sri Lanka. There is a bank branch called HSBC, but it's not a resident company in Sri Lanka. The non-resident company, they have a branch of business. Still, they are non-resident, but there is a permanent place, business place. So we have to check whether it is permanent place, but the permanency, whether they are doing business from that place. The case, yes, they are liable for Sri Lanka tax to the extent that, but amount derived or rising source in Sri Lanka. Right? Yeah. So that is expected. So generally, ideally, then what type of question? That computation of installment tax payment is based on that, right? And the payment, I could give some sort of this type of payment is making by the company. What could be what are the taxes? Just like say withholding tax, the AIT, right? So that will be the electric question. That's okay. So I will give another model paper like probably next week. I will upload another model paper so you can attend to that. Exam paper kan? Answer ka to. So then better I will put the answer paper. Then I will give the question paper to exam. Right. Sorry. So small areas to discuss. That is actually and somebody asked that, but in the transpricing also, I will give a small write-up. I mean, that's not much highlight in that part. The transpricing is a separate area, it's a big area. So we'll touch upon what are the administrative, the compliance requirement, and the method of using determine the arm's length price. That's okay. It's really in your question. So other by 3%. So have you scheduled a further discussion? Have you informed that they didn't share with me that link? I didn't see it. Today, right? And with social security contribution levy, as I told you that previously in 2009, we in Sri Lanka we have introduced nation building tax, and thereafter it in 2019 it got abolished, and 2022 we had again it was introduced just like as was the social security contribution levy. Basically, there are 4% recognized for that taxes. Person who is importing articles to Sri Lanka at the point of importation, and business of manufacturing. Manufacturer is a business of manufacturing, and business of service providing, and carries of the business of wholesale and retail, right? Including wholesale specifically means import and local sales. But this part has other two, which is recognized as buying and selling, including import and local sales, and doing as a registered distributor. So this the percentage is 2.5%. Just apply the 2.5% on the turnover, right? So for the what the turnover, if they have given definition is turnover for the importation. Actually, importation there won't be turnover, but for the purpose of charging SSCL at the point of importation, it says value which is ascertained for VAT purpose is the same basis that needs to be applied to compute SSCL at the importation. Is this automated system? Once they import, there all the taxes are charging, including what's the VAT base? It is CIF plus all the duties, PAL, sales, and everything, and plus another 10% of the CIF. That is the VAT base. On that, they are charging another 2.5%, and VAT on 18%. Right? In case of the manufacturer, in case of the total sales, whether received or not, and service provider also same. So, but when we work out the turnover, any bad debts we can remove, and VAT amount we can remove, and So in case of the import of any article, total amount we have to consider that the taxpayer. In case of the manufacturer, so amount revenue, the total turnover on that 85% is considered for SSC. That 85% is considered for SSC. Say manufacturer has made a sale of 100 million, so 85 million is considered for SSCL. On that 2.5% is supplied. Right? In case of the service provider, it is 100%. So service provider, we can provide services, 3 items recognized. In case of the supply financial services, very similar to the value-added tax base. When we discuss the value-added tax on financial services, I told you the total amount, including SSCL, we are considering value addition. Right? In case of the land and improvement of the very similar. So we can remove that land cost. Only improvement is liable. Right? Services other than these two, so 100% of services. That means say consultancy services, say they did 100 million worth of consultancy services for the period. So entire thing on that 2.5% has to be paid as SSCL. So in case of the wholesale and retail, it is in case the buying and selling, including import and local sales. Buying and selling, including buying. What is import and local sales, we are considering 50% of the turnover for tax purposes. Say there is import and local sales, at the point of importation also they are paying, and in the local sales, total sales, on that 50% we are considering, from that 50% we are work out the SSC liability on at 2.5%. Right? So, but in case of the registered distributor, it says local manufacturers appointing a distributor to sell his goods in local market at a given price. That is the registered distributor. Again, manufacturer appointing a person, distributor, to sell manufacturer's product in the local market at the given price. Right? He shall be treated as a registered distributor. Remember, that's what. The import and local sales, import also he can be considered as a distributor. But it's not the case because the registered distributor means manufacturer who appoints a distributor. That means local manufacturer who appoints a person as a distributor to sell his product in Sri Lanka at the given price by the manufacturer. Right? Price of the goods also determined by the manufacturer. Say, good example is say some domestic consumable item, just like liquid or whatever thing. The manufacturer is in Sri Lanka. There he can appoint a distributor. Say Manchu biscuit, Elephant biscuit. Right? They can appoint a person as a distributor. The price is already that it says that price. What is the maximum retail price in the product, right? Price has been determined by the manufacturer, not the distributor. Distributor is what they are doing. He is selling that good within the given the area at the given price. Right? He can be treated as a distributor. Right. Other than that, it shall be treated as the wholesale and retail. I mean, say, in case of the distributor, how is happening in the consignment base or whatever thing, he doesn't have the ownership of the product. Practically, how is happening? Say, manufacturer appointed distributor, he is selling goods to the customers who's within the period or the area. Right? He can log into the manufacturer's system and issue invoices. Is goes as distributor of this manufacturer. That means ownership of the good is not transferred to the distributor. Right? Shall be in case of the buying and selling means I go and I buy product. So thereafter I can sell at whatever price I am determined. Right? I can decide the price. But in case of the distributor, he cannot decide the price of the good because it's the market maximum retail price is printed in the product. That he has a commission income center. But for the SSCF purposes, you can consider, in case of the distributor, you can consider 25% of the total sales. 25% of the total sales for SSA purpose. On that, he has to pay 2.5. Whereas buying and selling 50% of the turnover at 2.5. Right? Again, the distributor means local manufacturer, appointed distributor. Appointed distributor. That distributor is selling the manufacturer's goods. Generally, in the wholesale market at given price by the manufacturer. Right? Right. So mandatory registration, that same method. Now, the threshold registration threshold is very similar to the value-added tax right now. Right? 15 million per 3 months period or quarter, scope that quarter, or 60 million per year. Right. That's the registration part. And tax return on tax payment on monthly basis, similar to value-added tax, right? So in a person who is submitting quarterly return, very similar. The return also quarterly, right? So tax payment to be made by 20th of the following month, similar to value-added tax, 20th of the following month, and return also 20th of the month after the end of the relevant quarter. So whereas value-added tax return is last of the month after the end of the relevant taxable period, right? So SSCL return is 20th, and the final or the third month payment also on 20th. That's clear. So exempted article I have given in the tutorial, you can read. Generally, in the planning question, I can test that one. What are the taxes if applicable? You can write that with that. Rent income, I told in the previous one, rent income, yeah. It also is liable for the sale. Right? In the computation could be similar computation. I mean, the very small computation can be given. So when it is a manufacturer and doing business in Sri Lanka, they what the total sales for the period, but you say the SSCL liability. Okay. Right. Any question? Yeah, uploaded this one to the environment. Of you small question. Right? Then tomorrow we'll have a practical calculation of value-added tax, and I will give small question related to the SSCL assets. We'll do another one question, and writing question. And also you can come with any areas that will be discussed. Right? Officially, tomorrow will be the last discussion. Right? Tomorrow will be the last discussion. The classroom. So if you need any, I can add another discussion via the Zoom platform for the team. In the team, you will try to discuss with the colleagues, and you can arrange one. I'm okay. But after this time, right? Right, okay.